Hi, my name is Jonathan Walton. I'm a director at Whitley Stimpson, and I'm joined by my tax partner, Owen Kiffin, who's also a director and a CTA tax advisor. Today, we're just going to give you a very brief outline on the origin of trusts and the taxation of trusts. So the origin of trusts is that they were used for estate planning and asset protection for absolutely centuries. Their usefulness and flexibility for these purposes has been proven for the test of time. The actual origin of them was found in the 11th century in the Crusades, when crusading English knights left their manors and estates in the care of trusted friends, hence the word trust, for safekeeping while they themselves were away on a crusade for often decades. However, trusts are not just some dusty, antiquated notion from manorial England. They're actually an effective tool for the protection of assets to control the ultimate destination through a series of beneficiaries. For example, marital breakdowns and protections of the vulnerable, to pass money down to minor children, etc., etc. But they also provide protection that a parent or a grandparent might want to ensure that the full rights to an asset may not pass on death, or to protect assets from those that are less entitled. So Owen has an example where a client made a trust for the grandchildren for the protection of an asset. Owen, would you like to provide that example?
Yes, this was a case of a family who I act for, where they sold some land for development and some of it was surplus to their requirements. So they thought they would do some early estate planning, get it out of their estate to reduce the liability to inheritance tax. So they actually put the land into the trust before it went for development, so it went in at a relatively low value. The money then went into the trust, and one of their grandchildren said they'd like to buy a house. So the trust, rather than giving him the money, they made a loan to him of £300,000, which he used as a rather large deposit upon a house for him and his new spouse. And him and his new spouse then moved in, very much enjoyed the property, and got a top-up mortgage to get the house they wanted. All was fine and dandy for 7 or 8 years, but then very sadly the marriage broke down. But because it had been funded by a loan from the trust fulfilled the very criteria and aims that Jonathan outlined, in as much as it was agreed with the spouse that she should quite rightly share in the growth in the value of the house, because she'd been paying into the mortgage each month. She'd been contributing into that. So there was no argument she should share in the growth in the value of the house. But the original £300,000, which had been provided as a deposit, wasn't lost as it might have been, or partly lost as it might have been if it had been appointed out of the trust to the grandchild. It was still a debt owing back, so it was adjusted for when the divorce settlement was made. So completely non-tax and trust protection outcome of a use of a trust.
And another example of a protection of an asset would be, and this applies to lots of families actually. So some people think that trusts are just for the very wealthy and the very rich, and actually that's not the case, because the inheritance tax threshold is so low. There's another one where there's an example of nursing home fees to protect the estate from that. Would you like to explain that a bit more too, Owen?
Yes, well, it used to be a planning technique, but a nil rate band trust can be used on the first death. So obviously, if I were to walk under a bus tomorrow, I would want my wife to be able to continue to live in our house and to be able to continue to enjoy income from our investments. So what I might do is I might choose my nil rate band on my death to leave £325,000, which is the current nil rate band, into what's called a life interest settlement, which Jonathan will speak of later, or an interest in possession trust, as it's sometimes called, which would give my wife the right to use those assets, whether it be the house for her to live in or the income generated by the investments, but she'd have no title to the underlying assets themselves. So she can continue to benefit from the assets, but she can't access the capital. Consequently, if unfortunately she needed to go into the nursing home, in evaluating her contribution to the nursing home fees, certainly the income of, let's say, some investments in that trust could be taken into account and recovered, but the underlying assets would be secured safely for the ultimate beneficiaries, which would be our children.
Absolutely. So I'm just going to talk about a couple of different types of trust. The most simple form, really, I suppose, is a bare trust, which is really, as I say, the simplest form. It enables you to transfer assets to a small group of people. And when you create a bare trust, you name specific beneficiaries who have an absolute right to both the income and the capital from the trust. And they're normally used for minor children who don't have the capacity to make legal title for themselves. So anyone who's under the age of 18 would be classed as a minor beneficiary. And the trustees you've appointed are simply looking after the trust assets until the child is old enough to take ownership. And they're most commonly used to make gifts to a child, but anyone can be named as a beneficiary of a bare trust. However, once they have actually been named as that beneficiary, you can't change the person who's entitled to the assets. And bare trusts are often used for when children become 18. Sometimes they can be kind of held in secret as well, where there's beneficiaries they don't even know about them. But when they reach that age of 18, they have a right to understand them. And when the beneficiary is then an adult, the trustee position is more likely to be like a nominee, and they have to follow the directions of the beneficiary in relation to the assets held, because at that point, they're deemed to have kind of grown up, I suppose. One of the things that's often used for bare trust is grandparents that want to start building a nest egg for their grandchildren and don't want to leave them to have access to the money until they reach their majority age. And it's useful from a taxation perspective because the initial gift into a bare trust arrangement is a potentially exempt transfer unless it's covered by an exemption. And providing you survive 7 years, there's no charge to inheritance tax. And one of the important things always about trusts, when you put money in, there's an assumption that money or that asset is going to grow. And so at the time you've put that money in, there's a level of protection as to the value that's gone into the trust. And if the beneficiary has no other taxable income, as is generally the case for a minor child, they would have their full tax allowance available to offset against any income or capital gains tax arising from the trust assets. There are no ongoing inheritance tax implications of a bare trust. The rules are slightly different if parents want to give to children. They're not as favourable, and you need to take advice about that because the limits are much, much smaller. There are drawbacks, though. The main disadvantage is that they do have a rigid structure. You can't change the named beneficiaries, and that can cause issues should any children or grandchildren be born, and you begin to want to, separate the value of the money that's in the trust and provide it to other beneficiaries, and you just can't do that. You'd have to set up another bare trust, but furthermore, the other disadvantage is that there are still some people who don't think their children are capable of looking after the asset at the age of 18. And as a consequence, some parents and grandparents will worry that the assets will just be sold and the proceeds wasted. So I think that's what I wanted to talk about for bare trust, really. The other type of trust I wanted to mention as well are nil rate band trusts. I mean, they're similar to, they have a similarity for potentially exempt transfers, and they're really useful for assets that have a low current value, but there's an expectation of growth. And as I say, if you put an asset in at, say £325,000, and you expect that is like maybe a building or something, and you expect that to appreciate over a period of time as a capital value, you're almost locking in the value of that gift. And of course, it's outside of the estate, and at a certain time, that asset will appreciate. And that even though you've pushed across the 325, if that asset's worth say 500,000 or 600,000 in 7, 8, 10 years or whatever, that's still come out of the estate at that lower value, and whoever the beneficiary of the trust is has received that asset, and it's now worth an awful lot more money. Owen, you had a thing about obstacle of assets getting them out of an estate.
So we might want to get an asset out of our estate, but it might be that capital gains tax is an impediment to doing that. So, for example, if I've got a rental property, an investment property I bought in the 80s, it could have considerable value now. It could be worth 500,000, and I might have paid 80, 90,000 for it back in the 80s. So if I give that directly to my child, my son, I'm deemed to sell that for capital gains tax purposes for its current market value. So I've made what we call a dry capital gain, because I've made a capital gain of £410,000 in my example, but I haven't actually had any money. So I've got nothing to pay the tax with on that. So one of the benefits, and this is common to pretty much all of the trusts we're talking about, one of the benefits of a transfer to a trust is that we can hold over the gain on the gift into trust, because the gift into trust is immediately chargeable to inheritance tax. And the tax law recognises it's not fair to have something that's chargeable both to inheritance tax and capital gains tax. So it allows you to hold over the gain, even though the inheritance tax might be zero because the value of the gift is under the nil rate band. So we can hold over the gain, and the trust takes on the original base cost of the asset for capital gains tax purposes. It's also possible, if you don't want to have the trust cluttering matters up, just to run the trust for a period in excess of 6 months and then bust the trust, get rid of it, to get the asset out into the direct ownership of the intended recipient. And again, on the way out of the trust, because it's at least potentially chargeable to inheritance tax, again, we can hold over the gain. I suppose one thing to note on this, which always has to be factored into the considerations, is really all you're doing is passing on the CGT, the capital gains tax problem, to the person who's going to be the eventual owner of the asset. And you're effectively giving up the uplift in this capital gains tax base cost that we normally get upon death, because we're getting the asset out of the estate before death. However, one has to say that inheritance tax is currently 40% on the whole value of the asset, whereas if we pass on the capital gains tax problem to the beneficiaries, that's currently going to be 20% or 28% only on the element of gain inherent in the asset. So, the CGT issue we're passing on might be the lesser of two evils in that circumstance.
And the next trust I wanted to mention was the interest in possession trust, which we have touched upon. I have a number of clients actually that where there's an interest in possession trust, and it's usually for a matrimonial home actually, where it's protected so that the surviving spouse, who didn't necessarily contribute originally to the home, or it's been in the family for years, has an interest to enjoyment. So there's a present right of present enjoyment in a property like that. They also have the enjoyment of the net income during the lifetime of it for the settled property, without any further discretion of the trustees being required. Now, the tax rates for interest in possession trusts are a maximum basic rate, but if the trust receives dividend income, there's actually no starting nil rate band for trustees. So some people have interest in possession trusts where the portfolio is in shares, and trustees just don't get those allowances that personal individuals do. But because interest in possession trusts are transparent for income tax purposes, it's a 7.5% dividend tax charge, and that's credited to the live tenant, and therefore there's a possibility of a refund. Owen, is there anything else you wanted to say on that?
Yeah, well, I think we talked about these in the context of leaving assets for the spouse to enjoy. As I said, it gives the spouse the right to enjoy that asset, whether living in the house or receiving the income, and it protects them from nursing home fees or even a remarriage. So you're providing for your spouse, perhaps after your death, but you're protecting the asset going forward. Mm-hmm. And as Jonathan mentioned, there is potentially a charge to trust rates of tax on interest in possession trust. But if the income is mandated direct to the beneficiary, it can go straight onto their tax returns, therefore possibly avoiding the need for a separate trust return and allowing the beneficiary to directly apply their rate bands and personal allowances, which Jonathan alluded to. So just quite flexible in terms of maybe simplifying the position.
Sure. And then I wanted to mention very briefly trusts for bereaved minors. So that's where a child who is under 18 has lost one parent. You can create a trust under a will or the rules of intestacy. There isn't a 10-year anniversary charge on trusts of that nature. The trust is actually never treated as part of the child's estate, even if it's an interest in possession trust. And there's also no exit charge when a child attains the age of 18. And there's a capital gains tax holdover relief claim under various sections of the Taxes Act. So it's sort of dealt with like a discretionary trust, I suppose, But the benefit of it is that you can put aside money, or someone can put aside money in a will for the protection of that asset for their the child that's under 18. There's also a trust for age 18 to 25. But since 2006, that's only applied to trusts that have been created by a will to defer children from accessing capital until 25. So that's quite a good planning tool for those that have slight caution of their child inheriting things at an age where they feel they might squander the money away. And there's no 10-year charge on that either. And then the final trust I wanted to really talk about was the discretionary trusts, which are a very flexible trust. They're sort of helpful as a vehicle for holding assets where the settlor is actually uncertain of their ultimate destination. And so the existence of a discretionary trust shouldn't affect any separation or divorce arrangements if the marriage of the beneficiary fails. But family courts have been kind of overturning decisions or changing their attitudes really over the last 30 years. And so for discretionary and accumulation trusts, they pay income tax at special trust rates of 45% and 38% for the tax year just gone. And in 2021, the first 1,000 income is taxed at 20% or 7.5%. And where income is received net, there's no further tax to pay to the extent that it falls within the £1,000 band. And there are sort of set off rules of how income for discretionary trusts are caught. So, Owen, did you want to just mention about the way of funding grandchildren's school fees through that and the way that the income tax credit works?
Yes, well, at first blush, as Jonathan's just mentioned, the tax rates, a 45% or a 38.1% rate on dividends seems a relatively high rate of tax to be paying. But if you then pay the net amounts from the discretionary trust out, let's say, for example, to grandchildren to fund their schooling or for other things like skiing trips or tuition or coaching in tennis or whatever you want to do, since the trust has paid 45% tax, any payment out to one of the beneficiaries that might be a grandchild would carry a 45% tax credit. So let's say, to keep the numbers simple for me, you've got sufficient income in a trust and your grandchildren's school fees for a year are £5,500. You pay the £5,500 out to meet the school fees, but your grandchild is treated as receiving £10,000, which is the £5,500 net plus a £4,500 tax credit. Now, because the grandchild has a personal allowance of somewhere north of £12,000, the whole £10,000 is covered by the personal allowance, and they can get a refund of the £4,500. So although it's a bit convoluted, it can be an efficient way of getting capital sums out of your estate and using those to go on to fund grandchildren's activities. And although you pay a relatively high income tax rate in the trust, there's a possibility of getting that back.
Thank you. And so as a planning exercise, for those that actually hold discretionary trusts, holdover relief is normally available for transfers of assets between a discretionary trust perhaps into an interest in possession trust. An interest in possession trust can often be more favourable from a tax perspective than the discretionary trust. So sometimes it's a case of looking at the trusts that people have to see whether they're the most efficient trusts, not just necessarily for the purpose of the beneficiaries, but for the purposes of taxation as well. Owen, did you want to speak about the IHT charges on relevant property trust?
Yes, so almost all trusts these days are going to be relevant property trusts, and they carry their own particular rates of inheritance tax, which are lower than the normal inheritance tax rate of 40% when you die. So the potential charge on the creation of a lifetime, the lifetime creation of a trust, if the value is in excess of 325,000, is 20%, which is still half the death rate, but still sounds quite high. But of course, there's no charge at all if the value is less than the nil rate band, which currently stands at £325,000. Well, that's £650,000 per couple, which is quite a lot to be able to get out of your estate, provided you survive the gift by 7 years with no charge to inheritance tax. Joint settlements are taxed as two trusts. So if my wife and I both settle a combined value of £650 for inheritance tax, that's viewed as two individual trusts, which have got 325 in them each. There is a 10-year charge to inheritance tax on relevant property trusts, but this is at a maximum of 6%. In practice, however, the normal rate comes out at much less than 6% normally, since each trust has its own nil rate band. So if we take the example of getting the 10-year charging date for a trust, and it's got a property in it that's worth £500,000, at the first 10-year anniversary, the tax would be £500,000 less 325, which is the nil rate band, times 6%, which is a tax charge of £10,500. So the effective rate of inheritance tax is 2.1%. If we hadn't got that £500,000 out of the estate, and the estate was chargeable on death, that would be an inheritance tax charge on the £500,000 of £200,000. So an effective rate of 2.1% and £10,500 got to be better if you don't need the value in your estate than a £200,000 charge on death.
And I think that example actually illustrates that you don't have to be super rich to think about the use of trusts for asset protection or for tax planning. The inheritance tax thresholds have been £325,000 per person for a number of years. So for a joint couple, it's £650,000, and lots of people have estates in excess of that value because, of course, the private residence, even though that has got its own small relief, that's part of someone's estate too. So it's not difficult to see that people have an inheritance tax liability. I mean, one of the biggest issues with inheritance tax planning is that people don't like to give away assets necessarily, but putting them into trust is where actually they can retain the control of that asset often, and they can express to the trustee through wishes to the trustees of how those assets are managed and what's done with them. So a couple of other planning points on trusts themselves. The first thing is that sometimes where there's cash in a trust, or people have put bonds in a trust, there are certain assets that you can invest in that qualify for business property relief, or you've got to watch the qualifying period of ownership for some of those. So they can often be a good way of pushing assets into a trust. There's also an alternative strategy of borrowing against trust property and investing in things like AIM shares. I think that's no longer a viable thing, but I think some people have done that in the past. But some AIM shares do still qualify for business property relief, don't they, Owen?
They do.
And exit charges before and after a 10-year anniversary charge are something that need to be looked at too. And the other thing too is that entrepreneurs relief disappeared in the budget a couple of years ago, and it was replaced by the rather unfortunate acronym BADA, which is business asset disposal relief. And business asset disposal relief can be available for the disposal of a business assets by trustees. So again, it's sometimes worth thinking about putting shares, family shares that are held by an individual into a trust as well. So it's not just necessarily property or cash. There are ways, again, but to protect that asset. And I think that was pretty much all I needed to say on those. Is there anything you wanted to add, Owen?
No, I think we've had a bit of a whistle-stop tour because it's such a big topic, really. But I think we've hopefully covered the main points, and obviously if anyone's got any queries, they can drop us a line or get in touch.
Thank you. One of the alternatives, of course, to using trusts are family investment companies, which we've also been looking at. So Owen and I have spent the last few weeks actually looking at different client scenarios. One is pushing assets into a trust. Another scenario is setting up family investment companies, which again are there really to protect an asset in a constitution of a company where the kind of parents or grandparents are the sort of directors and the controllers of the company, but the children and grandchildren and the succession of the families can benefit for the future. So again, that's another effective planning tool, again with the protection of the asset as being the core function, which of course was the whole point of the Crusades. It was really not necessarily about tax planning back then. It was to do with the protection of the assets. So that's the foundation of which trusts are built. But on the back of all of it, there are some tax planning tools that should be used when considering trusts. So if you want any further advice on this, just please contact us. My name is Jonathan Walton of Whitley Stimpson. My email address is jonathanw@whitleystimpson.co.uk. Owen's is owenk@whitleystimpson.co.uk. Our website is whitleystimpson.co.uk, and you can find out more about us and the services that we offer there. And thank you very much for listening. Thank you.